Welcome to the Power of Central Banks, a behind-the-scenes look at monetary policy. Today, we will delve into the complex world of central banking and explore their crucial role in managing monetary policy and regulating the financial system. Our journey starts with a simple question: what is a central bank? A central bank is a financial institution that is responsible for overseeing the monetary system of a nation. It serves as the bank for the government, commercial banks, and plays a pivotal role in influencing the country's economic policies and goals. The functions of a central bank are diverse and far-reaching. One of their main roles is to control inflation. Inflation, the general increase in prices, can have detrimental effects on an economy. Central banks use various tools, such as the interest rates, to keep inflation in check. Another vital function of a central bank is to stabilize currencies. Stable currencies are vital for international trade and economic growth. Central banks, through their control over the supply of money, can influence the exchange rates and ensure the stability of their country's currency. A central bank also acts as a lender of last resort during financial crises. When commercial banks face liquidity problems, central banks provide them with low-interest loans, ensuring the stability of the financial system. This function is particularly crucial during times of economic uncertainty. Central banks also regulate and supervise commercial banks to ensure the stability of the overall financial system. This regulation includes setting requirements for capital, liquidity, and risk management practices. Now that we've got a grasp of the general functions of central banks, the next question is: do they carry out these roles in practice? The answer lies in a field known as monetary policy. Monetary policy is the process by which a central bank controls the supply of money in the economy to achieve specific objectives. Typically, the objectives of monetary policy include controlling inflation, ensuring price stability, and facilitating economic growth. One of the primary tools of monetary policy is setting interest rates. By altering the interest rates, central banks can influence the borrowing, spending, and investment behavior of individuals and businesses, thus indirectly managing the inflation rate. Another tool of monetary policy is open market operations. Central banks buy or sell government securities on the open market to control the money supply. When they want to increase the money supply, they purchase securities, injecting cash into the banking system. On the other hand, when they want to reduce the money supply, they sell securities, drawing cash out of the banking system. Central banks also use reserve requirements to influence the money supply. Reserve requirements refer to the amount of funds that a commercial bank must hold in reserve, typically in the form of cash, ultimately controlling the amount of money a bank can lend. By adjusting these requirements, central banks can directly influence the money supply. Now, let's visit a typical central bank. Central banks are usually more than just one building. They can have multiple branches. Each of these branches carries out different responsibilities assigned to them. Most central banks will have a research department, which is responsible for collecting, analyzing, and interpreting economic data. This data is used to inform monetary policy decisions and predict economic trends appropriately. Typically, a central bank will also house the country's gold reserves within its premises. Historically, gold has been one of the primary assets backing a nation's currency, and therefore, the central bank's gold reserves are a critical part of its operation. The trading floor is the nerve center of any central bank. This is where the open market operations are carried out. The skilled traders, under the guidance of the central bank's policymakers, execute the bank's strategies to achieve their monetary policy objectives. We can't overlook the Monetary Policy Committee, MPC, an essential feature of many central banks. The MPC is a group of experts, including internal economists and external members, who review economic conditions and make decisions about monetary policy. We've explored the inner workings of a central bank and its role in monetary policy. But our journey doesn't end here. There are further facets of central banking to unravel, such as financial stability and the lender of last resort function. Ensuring financial stability is a preeminent goal for central banks. Under their financial stability mandate, central banks monitor and assess the financial system for potential risks and vulnerabilities and take preventive measures to address such risks, thereby safeguarding the stability of the financial system. The lender of last resort is the central bank's role as the ultimate savior during a financial crisis, intending to prevent a system-wide financial meltdown. When financial institutions face a sudden loss of confidence or a liquidity crunch, they can turn to the central bank for emergency funding, thereby avoiding a cascade of bank failures that could threaten the entire financial system. Another significant role of central banks is issuing and regulating the currency. While the day-to-day operations of currency issuance are often decentralized to separate central bank departments, the overall responsibility typically resides with the central bank. Central banks also are the primary custodian of the country's foreign exchange reserves. These reserves, typically held in the form of foreign currencies, gold, or special drawing rights, provide essential backing for the country's currency and are used for intervening in foreign exchange markets to stabilize the currency's value against other currencies. Central banks can also play a role in economic development, particularly in emerging markets. Through their monetary and regulatory policies, central banks can provide a conducive financial environment for private sector growth and direct credit to prioritized sectors, thereby fostering economic growth and job creation. We also cannot ignore the global interconnectedness of central banks. Relationships between central banks from different countries are essential for coordinating monetary and exchange rate policies, managing cross-border financial risks, and fostering international financial stability. In recent years, central banks have found themselves managing unprecedented economic challenges, such as low inflation, sluggish growth, and the impact of technological innovation on financial services. As a result, central banks have had to continually reevaluate their policy strategies and adapt to these new economic realities. With the increasing importance of digital currencies and the potential advent of central bank digital currencies, CBDCs, central banks are once again at the forefront of financial innovation. These digital currencies are a form of money directly issued by the central bank and have the potential to revolutionize financial transactions. Exiting times lie ahead for central banks. As they continue to evolve in response to global economic changes, their pivotal role in managing monetary policy, regulating the financial system, and shaping the future of finance and economics will remain unchanged. To conclude, we've received an enlightening perspective on the workings of central banks. We've seen how these institutions navigate between controlling inflation, stabilizing currencies, ensuring financial stability, while also influencing economic development and embracing financial innovation. Stay informed on this topic. Understand that changes in monetary policy made by central banks can directly impact your everyday life, from the interest rate you pay on a loan to the price of everyday goods and services. The actions of central banks indeed hold immense power, which, as we've shown, comes with significant responsibility. Embark on a learning curve. Challenge your understanding about the financial world, specifically about the operations, motives, and repercussions of central banks' actions. Only through a deep and comprehensive comprehension can individuals and societies successfully navigate the complex world of finance and economics, rallying together to build stable, resilient, and future-proof economies. Thank you for joining us on this journey into the power and importance of central banks. We hope to see you soon, on our next video. Until then, keep learning, stay informed, and nurture your curiosity.